you know what we always say, that your currency is going to end up like Zimbabwe. That's what we always say, and everybody that knows about hyperinflation knows what that means. Well, guess what, guys? Zimbabwe's up to it again. After they've been through a period of deflation, where their money's been becoming worth more, Zimbabwe's economy is experiencing inflationary pressures again. And there's fears that it's going to head into hyperinflation. Fund managers in Zimbabwe are shunning monetary assets and opting for real assets, amid growing fears that the country's economy is facing a crisis. Inflationary pressures are mounting since the central bank introduced bond notes. Their value is at par with the U.S. dollar. The country's monetary authorities say it's backed by a U.S. $200 million bond facility from the African Export-Import Bank. Prices of goods have been rising since the bond notes were introduced, with most shops setting up a three-tier pricing system: U.S. dollars, cash, bond notes, and bank cards. Hard currency, normally expenditures, external bank payments. Bond notes and card payments are accepted grudgingly. The bond's currency value on the black market, a good gauge of confidence in the unit, is weakening, with some forex dealers on the street discounting the currency. Those seeking to buy U.S. dollars are paying an extra $2 in bond notes for U.S. $100, or a premium of 2%. For groceries, one can pay a premium of up to 5% when not using U.S. dollars and paying with a bond note. You can be charged a premium of as much as 8% when you are using a card. Strong demand for the U.S. dollar and dwindling supply of points to a weakening bond, analysts say. For the first time in more than 2 years, Zimbabwe's year-on-year inflation rose in February. The country has mostly been in a state of deflation, but it's not why asset managers are concerned. Bond notes are largely seen as a straw breaking the economy's back, giving an already long list of problems such as worsening physical crisis, rising domestic debt, a slowdown in lending by banks, job losses, and company closures. Already, asset managers, investment analysts, and banking financial service executives have compared the situation to an accident waiting to happen. Others say the economy is already in crisis mode. Instead of investing in monetary assets like equities and bonds, investors are now buying real estate such as buildings and land. Okay, so what we see here is the crisis is coming back to Zimbabwe. It says inflationary pressures are already there, as evidenced by the February inflation rate, which brought Zimbabwe out of deflation. I guess it's up to 6.6%, their inflation rate, and then climbing fast. So I guess Zimbabwe is heading back toward hyperinflation again. We're going to have to wait and see what happens, but it looks like Zimbabwe is going to become the hyperinflation capital of the world. Thank you very much for listening, and like and subscribing. We will catch you in the next article. Bye.